Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Brian Levitt of Invesco joins us around the table here in New York. Brian, good morning to you.
Good morning.
We're looking ahead to economic data this morning at 8:30 Eastern Time. We're looking back at payrolls from last Friday, blowout payrolls report, and we're attempting to look ahead to more of the same. I just wonder how messy the data is going to be after the 1-2 punch we've seen across several states in America, Hurricane Helene onto Hurricane Milton.
Yeah, some of the data may be messy, but I think the larger themes are still in place. And I know that there's a lot of focus on today's CPI report. The reality is I continue to believe that the inflation story is largely behind us. It's passé. If you look at the Fed's preferred measure of inflation, very much in the comfort zone. If you look at the inflation break-evens, which give you the bond market's expectation of inflation, relatively benign. I mean, the inflation story was one of large stimulus and a pandemic that caused supply challenges. I don't think it's something that is re-emerging. Rather, it's a market that's responded to some good economic activity.
And it's responded as follows: a 2-year back at 4%, a 10-year back at 4%. How are you thinking about the influence of the bond market on the equity market at the moment?
I'm okay with that. I would rather see better economic data and less rate cuts than bad economic data and a lot of rate cuts. You know, the markets, the bond market's been moving in this 3.5% to 4.5% range, give or take, this year, depending on the direction of the data. Now, if you think of 4% is a general proxy for what nominal growth will be in this country, 2% real, 2% inflation. So that seems like a reasonable value. As things deteriorate in growth, you come down a little bit. So I think we're probably at the upper end of that range again. Yeah, we had a good payroll report, but if you look at survey data, it's somewhat mixed and doesn't seem like an economy heading into a recession, but doesn't seem like one that's reaccelerating either.
Which raises the question, did the sell-off in the bond market that we've seen over the past few weeks actually raise the specter of a pretty big rally if you get a downside surprise in CPI? In other words, does inflation start to matter a whole lot more again?
Maybe in the short term. But I would say in the long term or in the intermediate term, it's going to be more about growth. And one of the ways to think about it is just look at the correlations between stocks and bonds, which have, become negatively correlated again. So it's become a good news is good news, bad news is bad news type of environment. And so I'm focused on the growth side of this story. You know, when I see a good payroll report or a CPI report that's even a little bit above of what the expectation is. To me, I'm thinking that's a good nominal growth backdrop. That's good for corporate profitability. It doesn't increase concerns to me significantly that this Fed can't ease or the Fed may have to raise rates again or inflation's coming back. Again, I think that's a 2022 story.
So you like treasuries here in terms of where they're at and the value that they're giving. That's what I'm getting from you. We just heard Bill Waddell talk about a potential $450 billion in recovery funds needed to pay for what's going on in Florida. This isn't going to be the last. A lot of people saying these storms coming a lot more frequently. And aside from just the storms and paying for all of this, it raises the question of how much more spending needs to happen and whether that spending can really be tolerated by a treasury market where the auctions are starting to get messier.
Well, they may be getting a little bit messier, but we haven't seen the treasury break from nominal growth potential. I mean, people view treasuries as perhaps trading like a credit. They don't. The treasury market largely trades on the direction of the economy and what the Federal Reserve is going to do. So I'm not concerned that additional spending will cause rates to jump because we're concerned about the creditworthiness of the U.S. It's a rate that's going to continue to move in line with inflation and with growth. And, it's sort of like every time rates come down, you say to investors, well, you've been sitting in money markets, you should have locked in. This is like the third or fourth bite at the apple they've gotten. People used to beg me for 4%. Right? And now this is the third or fourth time they've had the opportunity to take advantage of that beyond 30 days. Maybe think about it for 5 years or 10 years. So I think investors should take advantage of it.
Hurricanes are not just going to be expensive, but the fact is they can also increase fuel costs. We are seeing this risk in the oil market, not just domestically, but also internationally, what's going on in the Middle East. What kind of impact do you see from the price of oil, not just on inflation data, but potentially also its relationship with the bond market?
Well, we know energy prices tend to rise late cycle, right? So that's a phenomenon where you get these moves in energy prices, and that's when the consumer rolls over. But let's think of the starting point. So the starting point is the U.S. is producing or is drilling more oil right now than any country in the history of the world ever, right? Some 13 million barrels per day or more. And we started this environment, or we've, the expansion of the Middle East war into Lebanon, with Israel and Iran, and these hurricanes with oil in the 60s in the United States. So we've moved up into the mid-70s, but certainly not the $120 that we were looking at when ahead of the global financial crisis. I drive around my neighborhood, gasoline's, $2.75. 280. So we're not at a level that's, prohibitive. In fact, that's part of the soft landing story. Consumer net worth at an all-time high, gasoline below 3. But yes, if this were to skyrocket significantly, I don't think that's an inflation story. That's a tax on the U.S. consumer story. But U.S. drilling hopefully prevents that.
So what's your biggest risk then to the soft landing scenario?
The biggest risk would be a rollover in economic activity. I mean, we've had interest rates high for a very long period of time. And, usually when the yield curve inverts, you wait 18 months for the Fed to have to normalize the yield curve and you go into a recession. And this time that has not happened. The bankers were tightening lending standards. Now they're not. Corporate bond spreads are very benign. So it doesn't feel like a recession, largely because most American households have fixed rate mortgages. So the increase in rates hasn't hit. Now, those are famous last words. Right? Anytime you're 2 years after a tightening cycle, you're saying no recession. You say, well, I guess we got through this. So that would be the risk. I'm laser focused on the growth side, not on the inflation side. But right now, the evidence suggests it's an economy that's pretty resilient.
Let's finish on earnings. Important 24 hours. Delta, JP Morgan, Wells Fargo, Bank of America, Savita Subramaniam. The bar isn't high. Do you agree?
Yeah, the bar isn't high. It's, the expectations are fairly low. We're likely to surpass expectations on earnings as we tend to do. And again, it's a good nominal growth backdrop. Investors sitting here looking at the equity market saying all-time highs on the equity market, can I invest? We've had, 1,200 all-time highs since the S&P 500 went live. And, people say buy low, sell high. I say buy high, sell higher. And I think we're in a, or maybe never sell. I think we're in a bull market, and peak inflation, peak tightening, peak rates should be good for equities.
He's still bullish. It's Brian Levitt of Invesco. Brian, it's good to see you.
Good to see you.
Thank you, sir. Tom, welcome back to the program, sir. Giant step back. Can we just spend some time from 35,000 feet? Can you explain to us how different this universe will look in 10, 15, 20 years' time?
Yeah, certainly. Today, the auto industry is about a $2.7 trillion industry. It's essentially a box with wheels industry with about 10% operating margins. The robotaxi industry will be about a $1.7 trillion industry, but massively more profitable, right? You and I, when we take an Uber, pay about $1 to $2 a mile. It only costs about 30 cents to operate one of these per mile. So it becomes a software business, a subscription-based business. And the multiples that these companies will trade at will be tech multiples. So I have Tesla at something like 250 billion out of the 1.7 trillion. But you apply a tech multiple to it, and now all of a sudden it's more than half of my entire Tesla valuation. So it dramatically increases the valuation of the mobility sector, the auto sector, because it gives all of us as consumers greater utility. We don't have to own a car, get chased by the cops, deal with parking, don't get into accidents. It's really a transformational thing for society. I'm sure we'll hear a lot about that tonight. It'll help solve the urban housing crisis, no more parking garages, etc. Really a breakthrough type thing for society. The real question, obviously, is when is this going to happen?
Well, let's talk about that, Tom. How quickly do you think we'll see the shift from consumers just pulling away from buying a single automobile and maybe buying a subscription to one of these services?
Yeah, I think this will be a very slow process. This is not years. This could even be decades. It will happen, though. We had Carlos Tavares from Stellantis at our conference a couple of years ago, and he said, you'll have to re-engineer cities entirely. He pointed out the example of the Champs-Élysées, where it's really a human decision of how to drive. And so cities will have to re-engineer themselves. Regulatory will be the big question mark that will need, and that's always a slow process. It will happen, but it will be years, maybe decades before we get kind of full ubiquity. But certain cities, you'll see it happen quicker than others.
Tom, I want to pick up on that, this question of the sheer technology of it versus the regulation of it versus the oversight, especially at a time where the host of data that you're going to need to make this happen, as well as the oversight and the potential manipulation of people's driving patterns, is going to become in cold relief when everything is a national security issue. How high are the hurdles? Do you have a sense of who's even working on trying to get some sort of regulatory framework and oversight into how this would operate, let alone whether it even could?
Yeah, I was at CES a couple of years back, and there were congressmen from, U.S. States who were speaking about this topic. So there is a political movement to get this happening, even in the U.S. It is a state-by-state issue in the U.S., but remember, we're saving thousands of lives, hundreds of millions of dollars in productivity, et cetera. So there is a political motivation to get it done, but obviously you have questions about liability. Does the automaker get the liability? Does the person driving get the liability? So the U.S. is somewhat complicated. Europe, it's even more difficult to get this on the finishing line. You have the European Commission, which is a multiple countries, have to all agree together. We all know how difficult that is. China, however, is, I think, we're ground zero where this will happen. We're already seeing it happen. Obviously central government can actually make this happen. So we'll see it happen in China quicker. My numbers have China with a much bigger robotaxi number than Europe or the U.S. Then it'll gradually happen state by state, I think, in the U.S. And then finally, we do think it'll eventually happen in Europe.
And Tom, the person who's leading the charge here is a politically polarizing human being, Elon Musk, and he's making himself more so. And I wonder whether that puts Tesla in a better position or a worse position when it comes to still being the leader of the whole robotaxi movement in the future.
Yeah, you guys probably know that. I can answer that question better than I can. But what I would say is I don't anticipate him doing something completely different than what we've seen already, at least near term, from robotaxi fleets from Cruise and from Waymo. I expect them to announce tonight a fleet service similar to that with their vehicle. Those programs already have approval, right, in the U.S., by those certain cities and states. I could see that being a similar path forward. But I do want to stress the technology that Tesla has with FSD is different. It is AI-based. We have it on the roads in Level 2 Plus in people's cars. It is very different, and it is better, quite frankly, than what from a lot of Level 2 Plus on the road that we have. And there is an arms race for NVIDIA chips, and Tesla has quite a lot. So, over time, I think people will look at the kind of proof in the pudding and see, obviously, the data that will bear it out. We have to see the safety statistics and what happens. But, it's an arms race for GPUs. Tesla has a lot of them. FSD is a great product. There's a lot of people working in this company, not just one individual. I think we all have friends who work there who are very interesting and dynamic people. And it's a dynamic company, first and foremost.
Well, no one said Elon Musk wasn't dynamic, Tom. You're very optimistic when it comes to the long term. Can we really narrow this to the short term? This event is delayed by 2 months. How high is the bar for Elon Musk and Tesla this evening?
Sure. I've said that near term, I don't actually expect this to be a big catalyst for the stock. It had run into the event. We had a delivery number that was in line, and the stock still kind of sold off a bit. I think there was some folks who moved into Tesla because of all the carnage happening from the German OEM's profit warning. Yeah. Never let a good crisis go to waste. I think I was the person who said that with you guys.
Thank you, Tom. Sorry. Credit.
Yeah, no worries. And so a lot of that happened, and basically, the stock pulled back. So it showed you that the stock ran into the event. So I don't anticipate a big up move, but I do expect that people like myself will finally get numbers on how to model robotaxis. I also think they could talk about Optimus, because on the invitation, it said "we robot." So I do wonder if we could hear more about Optimus. It's definitely not in people's numbers. So it could be a catalyst more longer term as we start putting these things, these higher multiple non-auto things in our models. We'll remember this day of, in the future and look back, as opposed to tomorrow seeing the stock price, demonstrably higher or lower.
Tom, how strong do you think some of the hands in this stock are now, given that Elon Musk himself said, basically, if you don't believe in autonomous driving, don't hold this name? That was basically what he came out with in the last 12 months. How strong do you think the hands are in this name, given the rally we've seen off the April low?
Yeah, but I think people are starting to believe. If not starting to believe, they have been believing in the past several months. I mean, you can't get to a market cap close to whatever $800 billion just on a car business. It just doesn't work. The math isn't there. You have to believe it's a tech company. And autonomy is one of the only ways you can really get there. I mean, not even with energy storage, not with regulatory credits. Autonomy is a real software subscription-based business. People clearly giving credit for it based on where the stock is, right? So I actually think folks are believers in it. We just need details more than anything, and not just PowerPoint slides. So we'll see the vehicle, I think, tonight. We'll see what it looks like. I mean, that in of itself is not going to get folks excited, but I think it'll give credibility that this is real and this is happening and could happen. We could have a service maybe within the next 6 to 12 months.
We hope. Been promised that for a long time. Tom Narayan of RBC. Tom, thank you, sir. Appreciate the update. Greenhaus of Solus Alternative Asset Management saying the stock market still looks good to me. Broadening gains are encouraging, and despite all the worries over everything, market cap and equal weighted indices are each essentially at highs. Dan joins us now for more. Dan, good morning.
Good morning, sir. How are you?
It's good to see you. Why do you always act surprised?
Because I'm not listening to start.
Thanks. You're listening now?
Now that my name has been called.
Live on TV. Good. It's good to see you. Dan. Look, equities at record highs. Credit spreads are incredibly tight. I think we should start in credit.
Sure.
When you look at credit right now, how tight are things at the moment?
Yeah, listen, they are, I think, depending on your index, you're effectively at all-time tights. I mean, that's not exactly true. If you use the JP Morgan index, for instance, their IG index is called 10 or so basis points away from all-time tights. The high-yield index is 90 basis points away from all-time tights. Bloomberg obviously has an index that's similarly close to all-time tights. But I don't think in that sense the credit market tells you anything that the equity market is not. We're obviously, as we've discussed and you discussed with other guests, pricing in, for lack of a better word, a soft landing or just a continuation of the expansion. And risk assets in general are appreciating in that type of environment.
Is it sufficient that they're even talking about interest rate cuts? Is that just good enough? The fact that we've got this backdrop for growth and we've got a central bank that's even having a conversation about lowering interest rates more?
Well, to state the obvious, we're not just having a conversation about it. We've already realized a 50 basis point reduction. We're probably going to realize 2 more 25 basis point reductions this year. There's obviously a debate about whether that's completely necessary or not, but from a expected value standpoint, that's probably should be your baseline. And so we're not just discussing it, it's happening. And so the more important thing for risk assets is not whether rates are going up or down, it's what's the broader economic and earnings backdrop. And in that sense, yes, rates are coming down, and that's an added benefit, certainly for companies that have to refinance in the maturity wall in the credit market, et cetera. But ultimately what matters is that cash flows still look pretty good, and the economy still looks pretty good. And so from that standpoint, why shouldn't risk assets appreciate?
There's a question about whether the bond market, treasury market in particular, is increasingly kind of dancing to its own music. As long as good data comes out, even if yields go higher, it doesn't really matter for risk assets. At what point is that sort of a threshold that gets crossed as yields continue to grind upward? Well,
I think it's also important for investors to remember that the relationship between yields in the treasury market and risk assets is a moving target. And in particular, in the post-2000 period, roughly, higher yields, which are associated with higher growth and not necessarily higher inflation, have been a positive for risk assets. They can move in tandem. And I think you had a period of time, obviously, where inflation was spiking, where that relationship was inverted. people were concerned about inflation. But as we've moved now towards growth concerns, right now I think higher yields are not necessarily a problem for the equity market in the sense that if they are corroborating the idea that the economy is continuing to grow, maybe the Fed, a lot of what's happened obviously is that the Fed can't cut as much as was originally priced in, stupidly I might add. But in that environment, why wouldn't equities appreciate even if the yield in the 10-year goes from 3.50 to let's say 4?
So to pair that with credit, is Solus thinking that structurally credit spreads are going to be tighter this time around relative to the higher benchmark yield, simply because the higher yield reflects how good the momentum in the economy is, which should, all things being considered, make a lot of the companies who even are lower rated look more creditworthy?
Yeah, no, that's 100% accurate. I would also add, and we've discussed this in the past, this is not your mother's credit market. It's a more highly, I don't know that my
mother had a really, really impressive credit market.
But I mean, it is true. The market is more highly rated. You have a higher proportion of debt at the top of the high yield structure than at the bottom. Companies have higher cash and lower debt to EBITDA ratios, leverage ratios. So there's all sorts of reasons why the market should be in a sustainable way tighter than what we've seen historically. And in conjunction with that, you have, to your point, the better economic backdrop, which improves the environment. Defaults are relatively constrained. So all of that together makes for a more attractive credit market and should, over time, obviously if we have a recession, this changes, but over time should support higher valuations in the credit market as well as the equity market.
Given everything we've said, what's your advice to people who have missed out on all of this and they're sat in cash? What do they do? Stocks at all-time highs, credit spreads very tight. Where do they go?
This is like the Sasquatch. I don't think those people exist.
You don't think they exist?
No, I don't think they're...
I know some personally.
Tell us what you mean.
Well, Lisa might know one person who has sat in cash for some time.
I think it's Lisa for what it's worth, but carry on.
But I don't think
Move on.
I don't think after a bull market, so to speak, in both equity and credit that has lasted this long, has not sucked in most investors at this point. And I think you're at a point in the cycle now where I don't think we should be having the conversation, is it a bull market, is it about to end, et cetera, et cetera. I think the conversation now should be considerably more nuanced than has been for some time, in the sense that, okay, things are doing okay, risk assets continue to appreciate, where's the outperformance going to come from? Is it still tech stocks? Should I rotate into energy? Is it defensives? What factors should I be overweighting, et cetera, et cetera? Where in the capital structure should I be positioned? Triple C's have had a very good year. Obviously, that's not a market so much as a bunch of idiosyncratic names, but those are the types of discussions that asset managers have all the time. But I think for a lot of viewers out there are watching should be happening to a greater degree today.
When you say that money doesn't exist, you're not saying that money's not real. You're just saying that that's not the kind of capital that's going to get deployed to risk.
Which money did I say doesn't exist?
Money market funds.
Oh, the 6 trillion, yes.
Sure.
No, well, listen, this is a favorite topic of mine. That 6 trillion exists, but I think people come on television and write notes and talk about it as if it's this monolithic item which is going to spur equities higher as the cash goes from 6 trillion to 2 trillion. That's not how it works. First of all, a portion of that money is institutional, a portion of that money is retail. Some of it's in tax advantage funds. It's not like they're all comparable to NVIDIA. But the most important point I would make, and I've made repeatedly and I will do it until I die, that 6 trillion needs to be scaled for something because numbers go up. So you can't compare today's 6 trillion to 6 trillion 5 years ago. What do you compare it to? My preference is the S&P market cap. How much is on the sidelines compared to the market cap? So let's do the math real quick. There's 6 trillion or so of money in market, there's 6 trillion of cash or so in money markets. Let's treat it like it's a monolithic total. Equity market cap, the S&P 500 is called 50 trillion or so. So that's, I don't know, 10, 12, something percent of the equity market cap. That's not out of step with what we've seen over the last 10 or 15 years. Yes, there's a lot of money on the sideline, but as a share of buyable assets in the S&P 500, if that's your argument, it's not necessarily high. That's not to say that it will not come down. It will. At some point, 6 trillion will go to 5 trillion, and some of that will go into the equity market. But do I think that is a reason for me to be even more bullish or bullish at all? No, I don't think so.
I can tell you that was such a much better answer than the first one. It doesn't exist.
Well, all I can say is, I love this. We should come up with clips.
I must have had a Will Ferrell moment. Okay, I don't remember saying the 6 trillion doesn't exist.
This is sort of a theme this morning, Dan.
Okay.
Honestly, to me, we should get clips of everyone saying money on the sidelines is a reason to buy, and then all the people saying money on the sidelines is a fiction. Stop it already.
Next time.
Okay.
I'm sorry. Go.
Okay. I am curious. I do want to get to this because Solus really specializes in distressed investing. Right now, the world that you just pictured, no distress there. What do you guys do?
Well, listen, distressed managers have been wrestling with this for many, many years, and I don't think Solus is any different in that regard. That is to say that when you, the traditional distressed manager in previous cycles probably doesn't exist much today. Solus does as much investing up the capital structure these days as we do down the capital structure. So we're capable and have owned, not Visa, but like we could own Visa, and we could own Dish unsecured bonds. And when you have an environment like we've had for some time where the Dish unsecured bond equivalent is few and far between, as has been the case these days, there's not so much workouts, there's not so many restructurings, you have to find risk-adjusted returns elsewhere. And we've done that increasingly in the equity market and up the capital structure. And I think that's been rewarding for us over the last few years. I think we're pretty pleased with our performance. The way that I talk about it is we're taking what the market gives us. We're not. There might have been a time where we were trying to force the issue and saying distressed managers, multi-billion-dollar distressed managers, this is the only sandbox in which we can play. We've traditionally played in that sandbox. We must stay there. I don't think we have that view and haven't for a decade. We're all over the capital structure, and I would argue justifiably so.
Are distressed hedge funds being made out of business by some of the big private capital funds that are out there doing a lot of rescue finance?
That doesn't help, but I think the bigger issue for distressed investors in general is there's just not been very much distress. The maturity wall, which everyone keeps talking about, hasn't been binding. Restructurings get done, and the lack of covenants in the loan market and elsewhere make it easier for companies to go longer before they enter court restructurings. And when they do, there's fewer assets to fight over, which gave birth to LMEs, with this whole separate conversation. But yeah, listen, again, I think we're finding stuff to do. We've talked about the energy market. Oil is $20 off its highs, but a lot of those stock names are basically at highs. We talked about the consumer ad nauseum on here. There's any different number of ways you could play the consumer. We've talked about cruise lines. We've talked about in the media space where Solus has a history. It's well known that we were a large holder of Mgmt Studios, so we have an expertise in that area. There's stuff to do there. I don't think there's any shortage of stuff to do, again, if you don't sit here and say that's the only sandbox in which we can play.
Dan, this was great. It's good to see you.
My pleasure as always, guys.
It was
Thank
real.
you.
It happened. Dan Greenhaus of Solus Alternative Asset Management.
I'm going to have to watch the tape.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.